What's up, guys? This is Shane Schofield from ScofieldTrading, and we're here to give you a market update. Just a quick disclaimer for you guys to look at. Just pause it and have a quick read through. Just always make sure that your risks are limited. About myself, I'm Shane Schofield. I'm the founder of ScofieldTrading. I trade US equities, and I'm a technical trend trader. I like to get into trends. Also a public speaker. I manage a private fund, and I started off spread betting from home, like most people would be doing, and turned a 4-figure account into 6 figures in 18 months. The ebook's available on our website, which is at ScofieldTrading.com, and it's just basically an ebook of the trade tickets and exactly how I did it and stuff.
Hey guys, my name is Ty Vinnick. I'm with the Ace of Swords hedge fund based in California, US. So on top of being a managing member in the fund, I specialize in options trading, futures trading on different market indices, different commodities. I have more experience with professional money-making strategies such as different types of option spreads, calendar spreads, etc. I'm more of a market timer than a technical trader, although I am also a technical and statistical trader, and I try to catch turning points in the market with good risk-reward versus the bulk of trends.
Okay guys, just a quick look at the Dow Jones Industrial Average, and this is a daily chart, and you can see that basically we've just been trending upwards still. One of my main things that I did mention I've been looking at is the sentiment, which is completely bearish at the moment. So 86% people short, which is me as a contraindicator for the market to look strong, because I think that the correction is due to happen at some point, but just not when everyone is expecting it. So the markets are strong, and then we have a mixture of earnings coming out. So the bank earnings come out, and obviously they've done quite well. There will be expectations. So I think the market is in a good, healthy condition. But I do expect a correction at some point, but I don't think it's not going to come until later down the line. And it's just going to be a basic sell-off where we're just going to have a significant pullback, which could potentially be a good buying opportunity for the long term. Looking at the stocks that we was looking at and getting into, a stock that's been doing well is the buyers in stock. I think wow. I gave the signal from around $22, $22.
And, yeah, even before, I remember.
Yeah. So it's doing extremely well. So it's like an e-commerce of China, and I think it's a massive company. I think it's still got room to run. And obviously, just trading with the trend, you just throw a stop loss, and then until this trend eventually does reverse. Another few companies that I have been looking at is SPWR, and this is SunPower Corp. And this chart is one of my favorite, where we just have a bottoming process and then eventually a temporary breakout, which I think could potentially keep on riding upwards. So I think this could potentially be a good trade. It's currently at $10. If you have a stop loss below, say, $7, I think this trade could potentially ride up. It's a SunPower. SunPower is a technology semiconductor company, and it focuses on solar powers. So that's, I think, is the next generation, and obviously it's kind of big in America as well, and it's coming over here a lot. I think that's a really beautiful chart. I really like the year-plus long basing pattern, and the fact you have this large open gap between $12 and $14. Oh yeah.
So usually, that at a minimum you have a target somewhere in the middle of that gap that is going to get filled at some point.
Yeah. So I think this company does look very strong.
How's the sector doing? Like the big companies like First Solar, FSLR, and things of that sort.
They all roll similar, so they all have a similar chart pattern. So again, breaking out again. So they all kind of follow each other a little bit, but I just prefer SPW, the SunPower.
Yeah, it's a little bit more beta. I used to trade a lot of First Solar in 2008, 2009.
Oh, really?
Haven't really looked at it in a few years.
One company that I do like on the downside is a company called TJX.
Retailers.
Yeah, of course. So this company, I think, is looking very weak. Taking away the fundamentals and stuff, just looking at the chart, you can see it's making 52-week lows. Broke out to new lows, tried to come back up, and then again it's close to new lows again. And I think once it breaks this level, it could potentially be coming down a lot more. It's a retail company, so it deals with department stores. I think they have TJ Maxx in America, and
Yes.
over here we have TK Maxx, which is basically the same company.
Oh, really? Okay.
Yeah, I don't know why they changed the name, but yeah, I think this company is not really doing well at the moment. But the results are out for this company on August the 15th, and we'll get an update, and we'll see what happens. So I'm personally in this short, and just looking at the retail ETF, which is XRT, you get a similar pattern. So very similar to TJX, where it's just making new lows, kind of bottoming out at the moment, but I think it's going to retest this level and potentially break it. And that's another signal for me. I like to short stocks where that are involved in weak sectors. So it kind of makes sense to kind of pinpoint the stocks that are bringing down the sector as well, and giving an overall idea.
Would you reckon this to be a 3-year complex head and shoulders in the making?
It could be. It could be.
Below 38, probably. That would
Yeah.
trigger that neckline breakdown.
Yeah, yeah. But I think it's definitely at dangerous levels. And I think retail companies are in trouble because, you know, you've got companies like Amazon and stuff, and everything's mainly based online, and different websites providing services and products for much cheaper. So I don't know. We'll see what happens. So I'm definitely short TJX. Another company in the same sector as Ralph Lauren, which is also doing a similar thing.
Mm-hmm.
So again, making new lows. I'm not in this myself. I'm personally in the TJX trade. I've got it till around October, and I expect to get an update on August the 15th and see what happens.
Yeah, that definitely looks interesting. Okay, guys, so last update, right before the 4th of July holiday, we were saying that this area could be a potentially rounding top and will be triggered below this 2400 level on the S&P, which never happened. The market just held that support and started climbing up. And we said that if it does go below this 2400 level, then we could at least target this open gap area at around 2100 and start falling. So obviously that didn't happen. The market has broken out from this kind of tight consolidation level. So what does that mean? Does that mean that we're going to move higher, move to new highs again, and resume the uptrend? Well, it could be. I'm still not in the camp of thinking that that's going to happen. I'm putting in a trend line right here in the S&P, and if I put the upward trend line in there, we see that we're sort of tracing out this wedge pattern because the highs that we're making are shallower and shallower. Unlike these highs before that we were making highs and significantly higher, the upward slope of the trend line is moving the same way, but the shallower new highs is an interesting place to me because if we do turn down from here during this following week and are able to break this level to the downside, I still think this will trigger this correction. And what we've done by going up is essentially made a bull trap, taken out a lot of shorts, a lot of stops. It's not uncommon for something like this to happen. So I'm still not in the camp of thinking that we're going to break out significantly higher unless we exceed this top of this wedge here. So to me, it's just a marginal new high. So I'm still seeing a lot of evidence to support this. The breadth of the market is still deteriorating, and the short interest in the S&P 500 has fallen to the lowest since May of 2007. So we're actually net short positions in the S&P sector are the lowest in about 10 years. One trade that was recommended 2 weeks ago was to short the banks being in this trading range and a potential double top. So bank earnings came out Friday, and they came out pretty bad. JP Morgan CEO actually said some nasty words during the earnings call, and they were essentially upset about the very low level of volatility. Banks actually like higher volatility because their trading revenue and trading business is more profitable from higher volatility. people buy and sell more stocks when the market's volatile. So their trading business has gone down, I think, 40 to 50% because volatility is just so low and nobody's actually trading. So we're seeing this in the banks. So the double top we said is a potential is still there. Stop is still above this high. Target is still first target here, and then second target here if we break down below that level. And I still think that can happen. It's interesting to me that the market breaks to a new high, but the banks are still doing this and doing what they're doing. IWM, small cap index, still looks the same as well. We can see that we had sort of a shooting star 2 days in a row, and we're seeing there's a lot of resistance around this level at 142. So this is interesting to me, where the small caps and the bank are actually lagging the broad markets, and I still think we have the potential of a major sell-off in the very near future. Couple that the fact that the VIX is at historic lows, tracing out the downside of this wedge pattern, that this has been drawn a while ago. This to me is a very good opportunity again to go long the VIX. I'm expecting that at some point this wedge is going to resolve to the upside, and we can easily see anything between a $20 and a $30 VIX. So that's sort of the update to those trends. So I still don't think that we have proof, so to speak, that the market is breaking to the outside. I actually think this point is a very low-risk short entry point because your stop is just above these levels, and this could easily at least go to this level, if not more. Anything you wanted to add on to that, Shane?
Yeah, that sounds about right. I think obviously if it breaks to the upside, you see it going further more to the upside.
So to me, what I think would happen, if you follow psychology of bull markets and how they perform over time, the correction in a bull market becomes less and less steep as time progresses. So what I mean by that, let's go here to a weekly chart and analyze. Here's the 2008-2009 bear market, bottom March 2009, and we've had meaningful 5 to 10% drops every few months reliably. This one was 20%. This one here was 20% or so, or a little bit less. 10%, 12%, 10%. So every few months you get a decent correction.
Which is just natural for the market to give it some breathing space.
It's very natural for the market to do that. Then we've had this double corrective period where it had also 15 to 18%, and we've had 10 to 8% correction. That's a 10, 12% correction all the time, like every 3 to 4 months. Now, since February of 2016, the most we've had is this correction here, which is less than 4%. So as the bull market progresses and becomes older, the corrections become less steep and quicker to be bought, which is ingrained the psychology of buy the dip in people. That's a dangerous development because it marks the end phase of a bull market. Usually when you have a lot of corrections and they become a little bit deeper like we've had before, the bull market's actually healthy because there's a lot of doubt that the bull market can go on, and at some point the sellers run out and then the market continues to climb to new highs. When selling completely disappears altogether and the most we get is a 2% pullback, that's usually happened towards the end. It happened towards the end in 2007, happened towards the end in 2000 as well. So if we do break out to new high here and go parabolic and continue to climb, I would see that as a blow-off type of top, which will indicate we have maybe 6 to 12 months left in the entire bull cycle. And this will be something similar to what we had in 1999, the tech boom, where there's just no drop at all and the market just shoots up to the upside. So if something like that happens and we do have this breakout to the upside here and we have no correction, we may have something that looks like this and then like this. So it's not necessarily healthy for that to happen. It's much, much healthier for the market to see these deeper pullbacks for a sustained uptrend. Like just as an example, look at the trend line that we have on the market. and look at the distance we're in from this bull market trend line. I think it's the deepest, it's the longest distance since maybe about here, right? Yeah, almost the same. And at some point, thinking that this is some kind of a regression channel, you know, you can use this as the same idea with a 200-day moving average, or, you know, 50-week moving average, or what have you. When you get so far away, what did the market end up doing? It just came back to it. So are we going to chop around and do something like this? I think so. And then at some point, this will be a much healthier development for the bull market. If we don't have this type of move and we just keep going up, I think we're setting up for a blow up top where, you know, the market just goes well above the trend and then just crashes down to the trend.
Do you think if it does eventually crash down to the trend, do you think there could be a perfect buying opportunity?
I'm not sure about that, because I think the bull market is really, really old. It's the second longest bull market in U.S. history, and it's close, very close, a few months away from being the longest bull market in history. And at some point, every bull market ends. And a trigger for that would be the violation of this bull market trend line. So if we do have something that looks like this, and then we fall down, and then we have a little bit of a retest, but we fail to make a new high, and then we break trend, then that's not a buying opportunity, because we can go into a bear market that can last a long time and can cause much deeper losses than anybody is used to over the last few years. So at some point, we're going to have a bear market. The question is when. You know, predicting a bear market is not easy, but it's pretty reliable. Like, we've never had a bull market that didn't have a bear market, right? It doesn't happen. There's always a bear market at the end of any bull market. So if you look at all the statistics of a bear market, just as a thought experiment to have people get an idea of what a bear market can look like, right? On average, a bear market lasts 1/3 of the time that the bull market lasted. So if we say this bull market started here in March of 2009, and let's assume it ends this week, just as a thought experiment.
Yep.
You know, 2009, 2017, we have about 8 years, right? So we can expect a bear market to last 2.5 years. That's a pretty long time. And how deep does it go? On average, when a bear market hits, it loses 1/3 to 2/3 of the entire profits the prior bull has made. So we figured that this bull market has made a profit of between $70 on the SPY to $245 on the SPY. So we could expect a drop that at a bare minimum takes you all the way down to here. And at a worst case scenario, takes you all the way down to here. So that's almost inconceivable for most people. But that's just the historical averages.
Yeah.
So we have to have that in the back of our mind, because we have to know that at some point this bull market's going to end. And our job is to figure out when and how. So the best way to do it will be to let prices tell you what it is. We know now that it's risky to buy because we're just too far away from this trend line. And here we were also too far away from this trend line. It lasted a few more months of just chopping sideways before we resumed. And then my biggest clue would be a fall to the trend line, an attempt to make a high that fails, and then a break of the trend line. This will be a classic tale that the bear market has started.
And then if you think the bull market is going to resume, you would expect that to make a new high.
That's exactly right. So the first test of this trend line is almost guaranteed to be a buy, because you will have an attempted bounce. And if this attempted bounce just goes like this, then we know that we're still in a bull market phase. Probably something like this would be more likely. So we know we'll be in a bull market phase.
Do you think there's any fundamental reasons that we could enter a bear market at the moment?
Without going too deep into the fundamentals, I think there are many potential reasons. I think that the market is extremely richly valued. We can see here that the S&P 500 PE ratio, price to earnings, is very richly valued at 26.01, with a longer-term average of roughly 15. So the market is very, very richly valued. If we look at the Shiller PE ratio, No. So the Shiller, I think, is more important than the regular PE ratio because PE ratios are forward-looking, and that's what analysts expect earnings to be 12 months from now. Shiller PE ratio looks at earnings in the last 12 months and assuming the market is valued based on recent earnings. So when the PE ratio is at 30, that means that you're paying 30 years worth of money to buy a business today. If we're looking at stocks as a business, we want to know in how many years from our investment will the business get us back to break even, right? If you were to buy a building, Shane, for example, you want to know how many years of rent would it take for your investment to come back to you. And if that number was 10 years, you'd probably buy that building because it's not too bad. You get the rent, in 10 years you get your money, and everything from there is pure profits, right?
Yep.
Well, you can think about it at the same time, at the same thing. If you buy a stock today at the current earnings of the stock, how many years is it going to take you to get your money back from buying that stock if you were treating that stock as a business? And today's market, that number is 30 years. Would you buy a building if you knew it would take 30 years in rent to get your money back? Probably not. So the long-term average here is roughly 20 to 18 or even less, around 15 over the last 100 years. It says 1890, even before. And today we're at the highest level of valuation in the market besides the 2000 top of the tech bubble where companies had literally no earnings and Black Tuesday of 1929. Spooky, isn't it? So
But do you think at the moment we're seeing something similar to the technology boom? Do you think we couldn't push higher with the amount of money floating about and that's printed out and stuff and technology and how quick people can pass money around? Do you think we could potentially break that and keep going higher with this?
Yeah, well, absolutely. That would be my blow-off top scenario. So that was the scenario I talked about first, where if we do see the break of that wedge on the daily pattern, I think we could see like something like this. And this. I think we could see that. So if we do see that, we will create an historical parallel to the 2000 level. And then you can see what happens when you reach these valuation levels. It just crashes. So the question is, are we going to have a healthier pullback now to the trend line that could potentially prolong this bull market? Or are we going to go blow off top where we have maybe 10 or 20 more % to go on the upside and create one of the craziest rides for investors we've seen in maybe 25 years, and then a crash back down. So I don't know which scenario is going to unfold yet. I'm tending to think that we'll see a correction out of this wedge pattern. But if we don't, and we do break out, there is a trade to be made where you can buy the market and ride this blow off top, because this blow off top may last longer than we expect. So we put a trend line in. We see the trend lines just keep getting steeper and steeper and potentially even steeper. So as a technical trader, you won't short this until this trend line breaks.
Yeah.
And potentially, this could go really accelerated, parabolic. I don't know if that's going to happen. This is just all a thought experiment. But I want everybody to know the potential possibilities that we can go from here. So either way, I think we're very late in the cycle. I think a bear market is coming probably next year regardless. The question is, will it happen in this fashion? Or will it happen in this fashion? So I think it's going to be a really interesting next few months to find out.
Yeah, definitely. Okay, guys, remember to sign up to our YouTube channel to get free video content on a weekly basis. We're going to be giving market updates. Contact us at contact@ScofieldTrading.com, and there's the website and also the phone number. Also, we have our options course, which is coming very soon.
Right. So here you can learn all the basics of option trading, learn all the secrets of hedge fund option spreads and things of that sort, how they make money on either of these scenarios we talked about. You can make money in all market conditions and limit your trading risk. So a good example of trading what we just talked about, we either have this blow-off top scenario that the market just explodes to the upside and then crashes, or we can have this bearish scenario where we can just break down through that wedge pattern, fall into that longer-term trend line, how would you trade that? Well, if the VIX is so low, trading only 9.5, the price of options is really low. You can actually buy options on both directions and benefit either if we have a blow-off top or if we crack down, which is pretty much the positioning I'm in. So it's going to be an interesting time. I'm really excited about this course, and we want to share this knowledge with as many people as we can.
Yep. Okay, guys. We'll speak to you next week.
See you next week.